Well, welcome back to the Entrepreneurial Podiatrist podcast. This podcast helps podiatrists in private practice grow more profitable and sustainable businesses while taking control of their future. I am Greg Hardy, certified financial planner and accredited estate planner, and joining me as always is Dr. Andrew Schneider of the AAPPM, president of the AAPPM. Andrew, how are you today?
I'm doing great, Greg. How are you?
Doing well. Always enjoy
Fantastic.
these days as we get closer to spring and digging through tax season. So it's busy as ever. But
Well, here in Houston, it's 82 degrees.
ooh, man,
Just rubbing it in a little bit.
nice. I'll be looking forward to
Yep.
some warm weather when I go on vacation in a couple weeks. But until then, it's
Nice.
head down, nose to the grindstone. So. All right, so today we are going to be diving into a topic that every practice owner needs to think about, but unfortunately, they don't always plan for this, and we're going to be talking about life and disability insurance. And as a podiatrist, you are the revenue driver. Your skill set, your procedures, your production, that's what fuels your practice. And so what happens if you can't work, even temporarily? We're going to break that down into real risks, the common planning gaps that we see, and the key decisions that can protect your income, your family, and the business that you've worked so hard to build. Andrew, let me ask you this. As someone who runs a practice every day, when you think about not being able to work for an extended period or possibly even forever, what goes through your mind?
Well, it's an anxiety producing question that you're asking because I'm a solo practitioner. So if it's not me, who is it going to be? And I've had some situations over the course of my years of practice even my very early stages of practice before I was licensed in Texas. I bought my practice and I had someone working for me to bridge the gap until I was licensed. And I was opening a wine bottle and the neck of the wine bottle broke and it fell into the bottle. And my finger went right on it was like a guillotine right on the side. So it sliced the skin and into the tendon. And that's my thought was, well, here I am. I haven't even started my practice yet and I can't work.
Wow.
So it ended up being healing before I got my license and I was able to work here in Texas. But it made me very aware that things can happen and it's things that you don't plan for. I did not wake up that morning saying, guess what I'm going to do today? I'm going to slice my finger open on a wine bottle. It was something that happened. And that's why planning is so important, because we have to, it's the uncertainty. That's why we carry malpractice insurance. Is why we carry any insurance. It's not because things happen or we expect things to happen. It's to protect us from when they don't happen or when they do happen and we don't expect it.
Yeah, very, very true. That's a great story. Thanks for sharing. Yes, life happens, and we don't always know or plan for what risks might come about, or have no idea. Like you mentioned, we never expected a wine bottle to cut your finger, but crazy things happen all the time. So, yeah, well, thanks for sharing that.
Yeah. Insurance is something that it seems like there's an insurance for everything, Greg. It's growing up, it's like, we play the game of life and you can pick up life insurance and disability insurance, and that's to auto insurance. And those are like the big insurance, medical insurance. Those are the big ones. But I know there's a lot more kind of insurance for almost every eventuality out there. So if you could prioritize one strategy early in their career, would it be disability insurance or would it be life insurance, and why?
Yeah, good question. A couple things. You're right. I mean, there's insurance for everything, right? I mean, you can get pet insurance and travel insurance and all sorts of things, and you can be certainly insuring your insurance. There was a commercial about that somewhere, but uh, we always are trying to look at things from a practical standpoint and have the right amount of coverage, but without over insuring. And so that right amount kind of depends on some stuff. And it depends on everyone's personal situation. But to answer your question, generally speaking, if you're just starting out in practice and you are the only practitioner, you probably want to make sure that you're insuring your income. And I know a lot of the programs, the schools and the resident programs, talk a lot about disability insurance and those types of things, and that's certainly important. And also, though, with that same breath, life insurance, getting life insurance early and when you're young is also a good thing. So I think having a balance there is certainly important. Uh, Statistically speaking, you're more likely to probably use the disability insurance. And so I would say protecting one's income at first and getting a good disability policy in place would be the primary first answer to that, though.
One of the insurances that I never knew existed until I got into practice was business overhead expense insurance. Why is that so often overlooked?
Yeah, well, oftentimes people just don't know it exists, right? And we're so worried about protecting our income. And so let me explain a little bit about what business overhead expense is. So, first of all, if you buy a traditional disability insurance policy for yourself, that is basically protecting your income, likely for your family. So if you have a business balance sheet on one side and a family or a personal balance sheet on the other side, that income from your personal disability insurance is protecting your working income so that you can still keep the lights on and food in the cupboards and things like that with your family. Now, business overhead expense allows you to do similar things to keep your actual business or practice running. It allows you to pay rent, pay salaries other than your own, pay other utilities and things like that. And oftentimes you could actually bring in a practitioner to potentially to replace you if you needed to do that as well. So it's a unique insurance. It doesn't, you're right, it doesn't get talked about as often as just an individual plan, but it's certainly important to consider all the other things that need to happen to continue to run the business if you're not there.
Right. How much monthly benefit should a practice owner realistically carry? You said that we shouldn't be overinsured or underinsured. Where's that sweet spot?
So usually, if let's say you're a part of a group or a facility or something that offers group disability insurance, okay, you can start with a group plan. There are some association related plans as well that are out there, and you could start with a group plan as kind of a baseline, and then you can tag on some extra personal coverage. By standards, you will only be able to get up to about 65% of a replacement cost for your income. If the insurance company's insured for 100% disability, then everybody would all of a sudden become disabled if they had no reason to work, and you could be at home and still making the same pay. So usually up to about 65% of your income is what you want to try to get to. And if your income is increasing, there are other types of insurance coverages through certain carriers that will start you out at a lower amount, and then you can actually purchase more in the future. It's guaranteed to allow you to purchase more as your income goes up, because um, with disability insurance, there's a medical component to the underwriting, but there's also a financial component to it. So you have to qualify financially to be able to purchase the insurance and justify the amount that.
That makes sense. I never thought about being insured 100%, that would that would people would exploit that.
Yes.
For about disability insurance, how is it different for a podiatrist versus a general professional? Any difference in practice?
Yeah, for sure. And as you get closer to a specialty of any sort, which podiatry would be, and then also I can think of additional specialties, and maybe you can expand on this as well. But in for someone that's just generally working a 9 to 5 job, let's say, okay, and maybe they change jobs from time to time, but they're really just trying to ensure their overall working income, no matter where the source is coming from. That is just kind of a general type of disability insurance. Now, for a podiatrist or someone that has even more of a specialty feature as a podiatrist in their practice, you want to have what's called an own occupation rider on your policy. And the reason for that is because if you're not able to substantiate or continue to bring income in based on those specific job duties, but you're still able to work somewhere else, then you won't be considered disabled unless you have that own occupation rider. So you want to have that own occupation rider that says, if I'm not able to practice podiatry, I'm considered disabled. Or if you're doing specialty, can you think of a specialty in podiatry, surgeon or something of that sort that would qualify for another own occupation classification, Andrew?
Well, I really think any of it, surgery certainly, within podiatry, even biomechanics. It really, there's, I think every aspect of it requires us to physically do
Yeah.
something. There's no, we're not just sitting and talking to a patient. It's not just our brains; it's our hands too.
Yeah, for sure. And the other thing about that in that own occupation, and some carriers will even classify it as what's called a true own oc. And with that being said, they can actually go back and look at what your last 12 months of billing codes were to justify if you were having a reduction in those due to the disability claim. And that can be the classification for your ONOC or true ONOC.
What if we are in a situation where we own the building or we have partners? How does disability affect these relationships?
Well, if let's start with the partners conversation there. If someone is in practice, and I'm just going to say two doctors are in practice, it could be more, but the math just kind of multiplies from there. So let's say you have two doctors in a practice, and in a normal buy-sell agreement, the buy-sell agreement's going to talk about death and disability. And so it's super important to have that disability classification in the buy-sell agreement and what constitutes disability as well. Because if a doctor hasn't necessarily passed away, but they can't come to work for, say, 3 years or something because they're battling cancer, then obviously the other doctor that's running the practice wants to have some sort of income or buyout clause in that buy sell agreement or something. And so you definitely have to think about that when you have multiple doctors. It's not just replacing your personal income, but it's also keeping the practice running efficiently as well.
Excuse me. Yes, you. You didn't become a doctor to manage retirement plans. This podcast is proudly sponsored by Beyond Financial Planning, partnering with the AAPPM to offer you, its members, a multiple employer pension 401k plan. If you have questions or want to dive deeper into today's topic, visit us at aappm401k.com.
There's a reach a point, life insurance. I know there's a difference between term and whole, and I still don't necessarily understand the difference between it, even though it's been explained to me a million times. But when does life insurance become a business planning tool rather than just protection for your family?
Well, I'll go back to the line that I mentioned about having a business balance sheet and a personal balance sheet. And when we talked about the disability side of things, the disability insurance was to protect your income for your family. And that's the same thing for your personal life insurance. You want that income to protect the income that you're bringing in for your family, so they can continue to do all the things that you've hoped and dreamed that they would be able to do, even if you weren't the one there to be able to provide for them, whether it's sending kids to school or supporting a spouse that's at home, whatever the case may be, right? That's the personal side of that income replacement piece. But furthermore, from the business, if you're a sole practitioner or a part owner of a business, you want to have some coverage for yourself and or possibly some key employees too. Even if they're not owners of the business, there could be key people in the practice that are very valuable, and you want to protect them, because if an owner doesn't show up to work on Monday, I always ask, what will happen to the practice? Will it still be running? Is it efficient as it was before? And oftentimes the answer is no, of course not, because they're essential to that practice. And then we have to look at, okay, what happens after that? Are we going to be able to sell the practice? Is it worth the same amount as it would have been before? Or is there another partner that could buy them out? And so the business insurance planning is almost completely separate than the personal insurance planning.
What mistakes do you see podiatrists make with life insurance planning? I'm guessing a lot of them, by the way.
Well, life insurance in general seems to be misunderstood quite a bit. And statistically speaking, only about 52% of people in the United States have life insurance. And most of the time it's because they don't understand it fully. And you'd mentioned that, whether it's the term versus whole life and what do those two different things mean, or usually oftentimes they overestimate the cost of life insurance as well. They're like, well, I can't afford that. But they never really looked into the proper amount of coverage or any coverage. So I think that the biggest thing is not separating the business from the personal side, because we're so involved, or a lot of podiatrists who are running solo practices or individual practices are so involved, and it's so ingrained with them individually. They haven't separated those two and considered that they need to look at the risk management of the business as a separate component than what they're doing on the personal side of things.
Should life insurance ever be owned by the practice instead of the individual practitioner?
Yes. So it can be a little complicated, but I will say personally, first of all, it depends. Okay. If it's a key person policy or something like that we were talking about. So if you have a salesperson or an office administrator that is just super responsible for the day-to-day operations of the business, that you couldn't function if that person wasn't there, you can have what's called key person insurance, and the business could own a policy on that key person. It could also be the owner, but that's a key person type policy. All right. I'll go back to the buy-sell arrangement. That's the easiest example to utilize, the personally owned versus the business owned. And so if you have two owners of a practice, they have an insurable interest in each other to have a policy on each other. And you could do a cross purchase agreement for them where they own insurance on each other outside of the business. And there are some tax benefits to that. I kind of like that personally. But there are other reasons to have the business actually own it. So let's say you have 5 owners, and you don't want to have all 5 owners have to get an individual policy on each other outside, because it just multiplies the amount of policies. You can have the business own those policies in that buy-sell agreement, and that's what's called an entity purchase, where the business owns it and then makes everybody whole should one of the owners pass away.
If you're insuring one of your key employees, it's a weird question, but do you need their consent?
Yes, absolutely. So there was legislation that was passed back in the early 2000s, and it was always the joke about like Walmart getting insurance on the janitor without them knowing. And so now you do have to have consent of the insured person. There's a notice and consent that goes out, and the applicant, the insured, has to actually sign it. Funny enough, even if an owner is the insured and is going to own the policy and is the business owner, they still technically have to get the notice and consent. You'd think that the business owner would obviously know that they were getting insurance on themselves, but anyway, that's Congress for you. So yes, they do have to be notified. They have to sign off on it. And if you own corporate insurance, there's a form that you're supposed to fill out each year that notifies the IRS of those policies that the business actually owns too.
How does personal net worth impact how much insurance a podiatrist needs?
Well, if you're separating those balance sheets, right? And I keep, going back to that, but it is kind of important to look at those two things with two different lenses. As you personally get more assets, you potentially may need less life insurance. But also, you may not just need less life insurance. The reason for life insurance may change or shift over time. So let's say you're 25 years old, just out of school, have a young family, and you're buying some inexpensive term insurance just to protect your family, right? You get $2 million worth of death benefit just to protect your family should you pass away. Well, fast forward 20 years down the line, and maybe you don't need $2 million of protection for income purposes. You may still want to use life insurance, though, as a planning tool for legacy planning or gifting strategies or things like that. And so the reason behind the ownership of life insurance could change, or the purpose of it. But and the reason I say that is life insurance is a great tool. One, because it's tax free, and two, it passes directly to your beneficiaries, and it's a very unique estate planning type tool. So sometimes we'll tell people to feel free to spend down all of your assets because you have this life insurance policy that you've left behind, if that's something that interests you, for your loved ones or your children's, for the heirs of the next generation, the rising generation. But typically, the amount of coverage does go down as people get more financially well off.
There seems to be a lot of nuance with this insurance thing you're talking about. It's there seems to be a lot more to it than just going and getting an insurance policy.
Yeah, it's not black and white. It is not like just going to a fast food restaurant and ordering, option 1, 2, 3, 4, 5 off the menu. It's very customizable. It has a lot to do with your personal goals and desires and beliefs. And then, building a risk management, whether it's an insurance plan or a disability plan or whatever type of risk management that you're trying to build a plan around, it needs to be custom tailored to what you're trying to accomplish, both on the business and the personal side as well.
It's interesting when people think about financial planning, they don't always think about insurance as a piece of it. They see insurance as the, kind of like the safety net, so to speak, but they don't see it as something that should work into a comprehensive financial plan. But clearly, I know you think otherwise, and you've demonstrated otherwise today.
Yeah, it does. It goes hand in hand. I mean, it really, they support each other. It also, your tax planning, your estate planning, your investments, your insurance planning, they all go hand in hand to make a well-rounded plan. And the insurance risk management piece of it allows you to support the rest of the other assets so that you don't have to, in a time of crisis, go and dip into, say, your 401k or your other investments or your other assets that you've grown, or you don't need to sell off a building or something like that in the case of a crisis, because you've essentially paid pennies on the dollar for the coverage that you've put in place. And going back to our first topic, there is a sweet spot, right? We don't want to just have insurance to have insurance, but the right amount is key.
Well, it sounds like a bunch of our listeners are going to go out and reach out to either their financial planners or to reach out to you and make sure that their insurance plan is where it should be. I'm going to.
Sounds good. I look forward to it.
Yeah.
All right. Well, thanks, Andrew. I always love the opportunity to share more about one of my great passions as far as financial planning and insurance planning goes. So as we wrap up today's recording, I'd like to encourage all of our listeners, if this conversation has sparked even one question about your current coverage, please don't ignore it. Too many practice owners wait until there's a health issue or a partnership change or a loan renewal to review the protection plan. And by then, your options can actually be limited. So just take 30 minutes and get some clarity. You can reach out to schedule a protection review so you know exactly where you stand and what gaps, if any, might need some attention. And protecting your income isn't optional. It's a foundational tool to everything else you're building. If you found this episode valuable, be sure to subscribe to the Entrepreneurial Podiatrist podcast, leave a review, and share it with another practice owner who could benefit. And to learn more about today's episode, connect with us online at www.aappm401k.com or www.aappm.org, or reach us by emailing entrepreneurialpodiatrist@gmail.com. Thanks for listening, and we will see you on the next episode.
Thank you for listening to the Entrepreneurial Podiatrist podcast. Click the follow button to be notified when new episodes become available. Visit our website at aappm.org or aappm401k.com. You'll find all our social media links in the episode summary. We'd love to connect.